Hey guys, I'm going to talk about some of the changes that have taken place on this most recent tax reform here, and I'm going to jump right into it. So, one of the changes is that you can take a Section 179 deduction on HVAC system or on a roof for a commercial property, but you cannot do that. Sorry about that. You cannot do that for a residential building, so a residential rental property. Still no Section 179 for those. Is the qualified business income deduction, that 20% of net income deduction, net business income deduction, is that allowed on a rental property? Good question. A matter of professional opinion. It's the IRS basically punted on that one. So sometimes I'm just letting my clients choose how they want to do it. My thought is if they've got one or two rental properties, probably is not. If they've got like 40 properties or 20 properties, it definitely is. And if they're, and it's everywhere in between, basically. But probably a lot of us are going to let the client choose what they want to do with that. I let my client choose today. He had one rental property in a partnership, and he chose to just take the more conservative route and not claim it. It was worth like $100 or $200 of tax savings to him. Anyhow, it wasn't much. The kiddie tax. So if kids have income from unearned sources that it's like in excess of, I don't know, 1,000 or 1,500, I think it is, then previously under tax law that income was taxed at the parent's tax rate, but now it's simply taxed at the trust tax rate. So it increases the likelihood that it will be taxed more aggressively than it used to be the case. Okay, they increased the standard deduction. They basically doubled it. So it increases the likelihood that we will use donation stacking. I would say that you may want to consider, and for my clients, I would encourage you to do this for sure. But there is in my reconciliation workbook, I have inputted this tab called Donation Stacking Planning. And essentially, it's supposed to be able to help you see if it makes sense to do donation stacking. And donation stacking, what do I mean? If someone's giving a lot of money to charity or a church or not-for-profit, then I'm talking like $8,000, and they're not itemizing otherwise. And even if they are, sometimes they may still come out ahead by anywhere from $1,000 to $5,000 over 2 or 3 year period of time if they delay donations in 1 year or and accelerate donations in another year. So basically, you're trying to take the donations you'd give over a normal 3 year period of time, you try to stack it all so that it's given in 1 calendar year. So for instance, for 2019, what we might do is tell our clients, hey, don't give any donations for 2019, and what you normally would have given in 2019, hold off and give it on January 1st, 2020. Then go back to your normal way of doing your donations for 2020. So you might give those evenly throughout the year, every week or once a month. And then for 2021, whatever you'd normally give for donations that year, you prepay it in December of 2020. So in that scenario, essentially you've stacked 3 years worth of donations into 1 year. And because the standard deduction is so large, sometimes over that 3 year period of time, if you add up 3 years worth of taking standard deductions, which is $72,000, and compare it to what you get for doing, if you did just the standard deduction for 2 years, and then you stacked the third year, or the second year. So let's say if they were giving $8,000 per year, they stack it 3 years, that's $24,000. Plus you've got your real estate taxes, and then sales taxes, and then any mortgage interest. Now these, again, if you add them up, they're only $15,000. So I'm not going to itemize here. If they didn't stack, they wouldn't itemize here, and then they wouldn't itemize here either. But if they do itemize, instead of getting just $72,000 of deductions, they're now getting $87,000 of deductions in the 2 years. So that now gives them $15,000 of extra deductions. If they're in a 22% bracket, that is that's $3,300 of tax savings just because they stacked it. So, if you're working on my clients, please, and you see this as an opportunity, please type it up in an email as a potential tax savings to the client, and fill this out basically, if you wouldn't mind, because this is something we should just be talking to the clients about. Because they may not itemize this year, they'll itemize this year, they won't itemize this year. Say 2019, 2020, 2021. Just as examples. If you don't understand what I'm talking about here, just come and grab me and let's make sure you understand it, because I think you should understand that. Okay, so no standard deduction. So people before, 15 to 25% of people were itemizing. Now they're estimating anywhere from, it's just 3 to 5%. And that's only from 2018 through 2025. So it's an 8-year period of time. Okay, so next on this list here is this qualified business income deduction, or Section 199 deduction. So this can get to be complicated. It's just based off of business income, which does not include capital gains, doesn't include dividends or interest. But excluding those items, you get 20% of your net business income. And obviously it gets more complicated from that. If it's a specified trade or business, a specified service, trade, or business, SSTB, then it could have limitations if, as a married filing joint couple, it hits 315,000, or 150, or as a separately filing or single filer, 157,500. And that's phased. Those phase outs are phased in over $100,000. So, and then just anybody, if they hit that level, they need to start showing W-2 earnings that are being allocated to them, or again, even if it's not an SSTB, a specified service, trade, or business, I think once they get to those income levels of taxable income, not AGI, taxable income, this 50% of W-2 wage limitation can come into play. Okay, so just know that that's going to apply to the Schedule C. It's an income tax deduction, not a self-employment tax deduction. It applies to partnerships, S corps, and Schedule Cs. It does not apply to 1120s. Okay, interest is another thing that's changed. Interest, let's go to those slides here. Mortgage interest deduction. Any married filing jointly taxpayer can deduct up to $750,000 of acquisition indebtedness. And this is from the tax period 2018 through 2025. So again, just for those 8 years. And it may not apply to a lot of our people, because unless they purchase a primary residence in that time that's going to be valued over $750,000, then I just don't see this as being an issue, because the other debt is grandfathered in. It may affect those people who have, so really someone who has $1 million property that they purchased 2 years ago, they still get to deduct all the mortgage interest on that because that's grandfathered in. Even HELOCs, home equity line of credit, if it was used for to buy or build buy a home or build a home or build home improvements, it's still, that portion of the interest on the HELOC is deductible. So we may need to kind of do some kind of allocation here, and that's why I've included here on this reconciliations workbook in the carry forwards and tracking tab. Here's where I say, what was the initial HELOC? Let's say, they initially had a HELOC where they had a line of 200,000, but they used only 150,000 of it max. At the beginning of this 150,000, what portion of it was used for home improvements, home acquisition or improvements of your primary residence? Let's say it was 50,000. So of that HELOC interest, only 33% would be deductible. So I think that that's something we're going to see this year, is some of this stuff on HELOCs. It's not fully deductible. Okay, so 529 plans. 529 plans can be used for private schools up to $10,000 for K through 12 now. Before it was only able to be used for colleges. I don't see this affecting a lot of people, because even if you could use it for private school, you probably wouldn't want to, because I wouldn't have had time to accrue enough earnings. But anyhow, it's now you can use it for private school for K through 12. Divorce decrees signed after 12/31 of 2018. Alimony is no longer a deduction to the payor, and it isn't a tax deduction to the payee. And if let's say they change their divorce decree after the fact, let's say they got divorced and got a divorce decree before 2019, but then they go back and change it after 2019, January 1st, 2019, what happens then? Well, it would be if they agree to make it, if they agree to making it deductible to making it non-deductible to the payor and non-taxable to the payee, then they can agree to that. But it doesn't, just because you augment the divorce decree after January 1st, 2019, doesn't automatically make it non-deductible to the payor and non-taxable to the payee. It's got to be agreed to. Okay, and again, 2018, it's the same as normal. And if you got divorced before 2018 and you've got alimony being paid in 2019, it's still a tax deduction to the payor and taxable to the payee. It's only for divorces that start after January 1st, 2019, or on or before. Okay, so bonus depreciation. For this year, bonus depreciation is 100%. Let's see here. Where are we seeing that? Here we go. Okay, so ever since September 28th, 2017 and through 2022, 100%, we can take 100% bonus depreciation. And the other change with the bonus depreciation is you can now take it on used property. So that's a nice benefit as well. The issue that we have not had clarified, and really was just an oversight in the tax law, is for qualified improvement property. They said what it is, but they never really specifically enumerated the benefits. So we don't know if it's eligible for 179. We don't know if it's eligible for bonus. We're going to have, that should be part of our discussion, and to see how we're going to handle that, because I don't know. I haven't heard they've changed the law on that one, and given their current level of dysfunction, I don't have much faith in their ability to get it done. Okay, child tax credit, that is eligible, they're eligible for $2,000 tax credit. Not on every child. Okay, so yeah, so it's not for every child. So it used to be that you'd get an exemption of $4,000. Those exemptions are gone. Now you get a $2,000 tax credit, child tax credit for every child under age 17. And for everybody else is then going to qualify as an other dependent. And other dependents, so if you've got an 18-year-old or a 17-year-old living at home, or you've got someone who is, if you've got someone who is younger than age 24, who's like in college, then they would be an other dependent, and you get a $500 benefit for being able to claim them as a dependent. So tax exemptions are gone from 2018 through 2025, but you have these child tax credits. So if they're in college, they may be better off just claiming themselves, frankly, if they're with the American Opportunity Credit. The education credits, the thresholds didn't go up, so it's still sitting at like $130,000 when it starts getting phased out. So the child tax credit, the $2,000 and $500 other dependent credit, is that doesn't get, the phase out went up way higher for that. So now it's before, I think it started at $110,000, it started getting phased out. Now it doesn't start till an AGI of $400,000. Or it might be taxable income of $400,000, but either way, it's much higher. So many more people will be taking that. Okay, for C corps, NOLs cannot be carried back starting in from 2018 going forward. NOLs can only offset up to 80% of taxable income. So let's say you've got a $200,000 NOL you're carrying forward. It's indefinitely carried forward here on out, but it's only if you've got make $100,000 this year, you can only offset 80% of that taxable income. So you'd use up $80,000 of your NOL. You have $120,000 remaining on the NOL, and you'd pay tax on $20,000. So 100 minus 80% is minus the 80 grand. So 20,000 you pay tax on, and it's just a flat 21%. So before it used to be like used to have brackets for the C corps. Now the people who are not making as much as C corps are going to pay higher taxes because, again, getting rid of the NOLs, and they're allowing the NOLs, but they're only allowing you to offset 80% of taxable income. And from dollar number one of taxable income, you're paying a 21% tax rate. So it was really geared, the tax reform is really geared to benefit the large C corps that make money. Okay, there's no more P's limitation. So you remember the P's limitation, that was named after the congressperson who put it into place, which basically it was a phase out of itemized deductions on Schedule A if your income got to be high enough. And you had to be, I think it was like 365,000 or something. So it was pretty high. Okay, we talked about the interest deduction. Professional gamblers cannot write off business expenses. They can only write off gambling losses up to the amount of income, gambling income that they have. Moving expenses are gone except for active duty military, which is basically gone for everybody. I don't even know why they included that, because active duty military, the Navy moves you anyhow. So it's stupid. Okay, miscellaneous itemized deductions that are subject to the 2% of AGI limitation, those are gone as well. And I believe those are coming back in 2026 as well. Medical expenses, you know, usually it's 10% of AGI before we start being able to put those on Schedule A. Until, however, those are eligible, those are at 7.5% until 2019. So basically, just for 2018, it's 7.5%. So 2019, they start back up it starts being 10%, which should not, I mean, this should affect many fewer people anyhow, even fewer than it did before. Okay, so, and they also have this, so if you had a loan on a 401k and you changed jobs, then really you had 60 days to repay the loan. Well, they changed it so basically you have until you file the tax return. So you could take until October 15th to repay that loan and basically refund your 401k, and you won't get hit with a 10% penalty. You won't get hit with the income tax on that either. So we're calling that the extended rollover period for the rollover of a plan loan offset amount. What? Yeah, extended rollover period for the rollover of plan loan offset amount. Try to say that 3 times fast. Okay, AMT, alternative minimum tax, is gone, basically gone for 1040s, and it's 100% definitely gone for C Corps. ACA penalty, the Health Obamacare penalty is still in effect in 2018, but now in 2019 it is gone. Vehicles, if there's a trade-in on a vehicle, there needs to be a taxable gain, and it, you know, for a lot of people it may not affect them if we're expensing the new vehicle fully, because their basis in the new vehicle will kind of include the gain tax, taxable gain amount. But it could still cause issues, because let's say you do a trade-in on a vehicle and you've got it, let's say you expensed it 2 years ago under 179. So let's say you've got 30,000 of depreciation recapture, and the new vehicle, let's say that you're going to write it off over 5 years for whatever reason. So it could cause some issues, but essentially there are no more tax-free trade-ins allowed under Section 1031 for vehicles. Section 1031 still exists and still is in play for real estate. And the last item here I wanted to go over is that entertainment expenses are no longer deductible. Meals are still deductible up to 50%. That's the high-level synopsis of the changes that have occurred due to tax reform. So I would say jot down any notes and let's just kind of discuss it during the tax meeting before we, you know, as we chat, rather than me going through all this beforehand.